We are in historic times right now as we watch the implosion of the financial system. You came here for the truth, so let me unveil that for you. Let's get into this right away, talking about bonds, stocks, and the disparity between oil. We have seen oil decline recently, and there are of course many reasons for that, but I wanted to highlight this right here. U.S. shale production on the margin is at risk. So we look at the price of a new mine opening or a new well opening. For any commodity, there needs to be a certain price involved, which makes it profitable. Once it goes below that, you're not going to have any new mines or wells opening up for that particular commodity, which of course affects the supply and demand fundamentals. And that of course really says that it's a reality, but we know that the markets are very fictional. So let's just go with this for now, looking at the fact that this has dropped or is around the level of it not being profitable anymore. So the price of oil in the future could also be high as well because of this. But we don't know what's happening because they are playing games with the derivatives. We talked about other instances with Saudi Arabia playing ball here, even though on the surface level they are definitely having a lot of rhetoric around this. But regardless, I just wanted to mention that. And connected in with this, we have Bloomberg talking about the Fed's decision to keep benchmark interest rates at record lows for 6 years has encouraged investors to funnel cash into speculative grade securities to generate returns, raising concern that risks were being overlooked. And I want to connect this in with what I just talked about with oil, that there could be 1,000 different reasons. Is it Saudi Arabia? Is it the U.S. shale that's the problem? All I need to look at is that with interest rates this low, anything can happen. Anything in the markets could occur because of these artificially low interest rates. You know that it's a problem when they have to keep it this low for this long and they still can't get the economy going. That's the point I'm trying to make here. So let's move on to this. This is the speculation that I'm trying to talk about. Want to get rich? Don't pay off your student loans. This is what CNN is telling the people right here. Don't pay off the student loans and instead put your money in the stock market because you're going to be able to make more money. And that's the way they always have said this. There's always a euphoria. There's always a mania that occurs. You may have read about them in the past, the tulip mania just being one example, where a simple commodity could be worth astronomical values, knowing specifically that it has no real fundamental wealth or no value necessarily, or at least the value they associated with. And this is what happens when you have the stock market explode to explosion levels. This doesn't make a single ounce of sense. That's when we know we're getting back into that roaring 20s sort of, right before the Great Depression moment here. And this all connects in with Fitch downgrading France to AA. And they're saying, of course, the outlook is stable. Right from Fitch's website, they downgraded France's long-term foreign and local currency issuer default ratings to AA from AA+. Now, they all use their own sort of different scheme. The fact is that the ratings agencies are downgrading all of these countries. They downgraded the US and so many others because they know that the risks are apparent. You're supposed to have many countries with the AAA rating, and one by one they're going down. And you see this occurring when they actually should be improving. They're saying that the economy is improving, yet the ratings agencies, who are totally in collusion with them, are in fact bringing them downward. And this also is in my book here, where I talked about the CDOs, collateralized debt obligations, but that's asset-backed securities, other types of derivatives here. And I said this: the CDOs were then combined with other CDOs to form CDO squared, and then on to CDO cubed, and this expanded to an incredible level that has now plagued the worldwide markets with a disease that can only be cured by an economic detox. That is what the world needs, but that is definitely not what the world will get. That's for sure. So if we move on to this, and it's basically talking about Japan's $1.1 trillion government pension investment fund, the world's largest. I would like to say why it's the world's largest is because Japan has been printing up the money to buy shares of its own stock market. So when you see the stock market in Japan moving up, that's not real investment. When you see the stock market moving sideways, nobody's investing. And when you see it moving down, all real investment is pulling out. That's what's happening right now. And they're admitting it. There's no real hiding from that. They're actually trying to use that as a strong point. So it said this: the fund, which plans to add more Japanese stocks and reduce local bonds, must be ready to buy more shares should Abe's policies succeed. They as a matter of fact, they're going to have to buy more and more of these stocks to keep it up. That's just the way it works, and they have to buy up 80 trillion yen a year, and that is just something that has to increase year over year over year. It can't go any other way. Now, Japan right here entering a quadruple dip recession. They're going to have to decline again. There's no way they can get out of this. They're going to increase the amount that they do the printing, buying up the stocks, but ultimately will be a failed experiment, really, because they cannot grow out of this. There is no growth occurring. There is only quantitative easing. And this also connects in. It's pretty scary, actually, when you look at this. This is scarecrows outnumber people in this dying Japan town. And you see the scarecrows all over. This article is out of the AP, and they're actually making scarecrows to fill the void of the human beings that were there before. It is pretty amazing to see something like this. But the reason I mention it is that Japan and other countries, of course, are having populations that are declining when this is a big problem, for example, with the baby boomers in the United States and others, where we have people that are aging and the Social Security programs, for example, are unable to sustain themselves the way they're going. This is something to look at in the future. It has nothing to do with the derivatives or anything like this or the stock market necessarily, but we just need to look at the simple fundamentals, and we need to calculate it, the mathematics of this. It's simply impossible to pay back. Look at this. Senate panel votes to authorize U.S. war on Islamic State. A very general theme there. It's like the war on terror, no different. And this is out of Bloomberg. A Senate panel voted to give President Barack Obama, the emperor, a 3-year authorization to use military force against the Islamic State. You can go on and read it for yourself for more detail, but essentially this is the way it goes. Our money is not being used into fuel the things like Social Security, like these pension funds that are desperately in need of funds because of the squandering that has taken place. They actually intergovernmental debt in the U.S., I believe, was about $5 trillion. That's money that they quote-unquote borrowed from the Social Security in order to pay off their schemes like this one, like a war against the Islamic State. So they fund it. It's actually funny the way it works. They have to fund the Islamic State in one regard, and then they have to go in and fight them. So you're actually, as a taxpayer, U.S. taxpayer, you are paying 2 times for the war on the Islamic State. You're funding them, and you're also going ahead and attacking them. It's pretty amazing the way the military-industrial complex works. They've done this forever, as long as I'm aware, where they fund both sides of a war. This has been going on for centuries, and if not thousands of years. But any documentation, historical data, will tell you that both sides of the war are always being funded by the same people. And right here, a really big news out of Forbes: with the Dodd-Frank rollback, the big bad banks are back. What it's talking about is, after the financial crisis, they obviously had big holes in the financial system. They implement this Dodd-Frank bill, and they said that this is going to prevent the crashes from occurring in the future. The taxpayers want to know what's going to be done to prevent this. They implement the Dodd-Frank bill, and of course goes along, and it's just repealed a few years later. Look at this. The provision enables the big banks, once again, to use the insured deposits and other taxpayer subsidies and guarantees to gamble in the derivatives market. This is Forbes saying this. This is not the Money GPS you're reading right here. This is actually right out of Forbes. And they're saying this because it's the truth. It's pretty amazing to see that, how they stick things into other bills. And, you know, this right here was the one I did about recently with the $1.1 trillion spending plan, and they just stick it in there with a provision that cancels out the previous one. Glass-Steagall Act was taken away, and all of the semblance of safety and security are gone from the markets. This is when we have a crash. And when you try and actually do something in the government, like Senator Elizabeth Warren questioning Wall Street's enforcement strategy following the JP Morgan CEO Jamie Dimon $8.5 million pay raise, she was questioning them and saying, look, you actually gave him a raise of $8.5 million. He's now making $20 million in compensation after they paid $19 billion, I believe it was, in fees for doing illegal activity. And then they praise him and actually give him a multi-million-dollar raise. And that's the way this system works. You cannot control it because it's completely out of control. That's the way this has been working now for years. They continuously repeal any semblance of, you know, constriction on these derivatives and on the big bankers, the world bankers. Nothing like this will ever be saved. It is all right now imploding before our very eyes. We see that happening. We look at Japan, and that is the future of so many different countries. Look at Venezuela right now with massive levels of inflation rates. They need to use all sorts of different schemes and scam in Europe to make their GDP look better, like actually including illegal activity as part of the GDP. There's all gone right now. I continuously run into people who try and tell me that the stock market is going up and therefore I'm wrong. But when you have central banks around the world printing up money which devalues their dollars, any asset can rise. That's not what I'm saying. You can have the assets rising, but the dollars are being devalued. So when you go to the store and you need to buy your food, you need to buy your groceries, they're more expensive. So while the stock market could be going up, which not all stocks are going up, only select ones, but that's pushing the stock market higher. They're having billions upon billions upon billions of dollars of stock buybacks, pushing the stock market higher. Central banks printing up the money, forcing it higher, and interest rates for approximately 6 years at 0% are pushing the stocks higher. This is all going to come to an end. If you found this video informative, please give me a thumbs up. And of course, don't forget to become an insider. The Insiders is where I give out all my best intel for free. That is available at themoneygps.com. You scroll down to the bottom, fill in your email address, and you get occasional emails from me with good, short, concise info.